The bank crisis. Can you believe that it's still going on today? The mainstream media doesn't really want to cover it. The alternative news can't figure it out, and that's why you are here. My name is David Quintieri, and I've been looking into this information related to the financial system for well over a decade. I am in the trenches so that you don't have to be. In this video, I'm going to explain what's happening in the bank crisis, how right now it's actually worse than it was a few weeks ago. You came here for the truth, so let me unveil that for you. First things first, I got to show you what's going on here. More and more of these financial institutions are seeking out help from the Federal Reserve. Isn't that a concern? Shouldn't that be, alarm bells ringing out there? What about the fact that Warren Buffett sold $13 billion of stock at the same time he's telling everybody, hey, don't worry, everything's all good? I think we've got to look at this and realize that there's a lot more to it than what the mainstream is going to tell you. Here we have it. You could see money market funds continue to accelerate. What does this mean? You've got companies, big banks, regional banks, that are basically seeing a lot of their deposits going to other places such as money market funds. That's essentially cash, okay? So they are worried, people are concerned, they don't want to leave it in the bank, they want to put it somewhere else where it can be deployed quickly, and it's not necessarily under their mattress, it's not necessarily in gold, although gold is doing well in general. You could see that the money is just going to somewhere what they deem as safe. Here we have it. You can look at it comparing money market funds, institutional money, and that has been on both sides of that equation. Money has been flowing in there, okay? Money market funds generally, like a little while ago, was seen as like this really unattractive asset because you're not going to get any money from it, right? You're not going to get any yield from it. That's when interest rates were super low for super long. Now you change the tune here, interest rates have moved up. At the same time, by the way, you see all that turmoil, and certainly a lot of people are looking at it. They'll take anything. Hey, as long as I don't lose my money, I'll just put it there. That's what's going on right here and now. Then we have this. You're looking at the basically the commercial liabilities, and what I believe is that you can see a bank run essentially taking place, okay? That's what's going on. It's happening in a digital format, and we're seeing that right now here today. A lot of money is being pulled out, and it's going into, well, in some cases, it's going into JP Morgan's pockets, and it's going into other places as well, big banks. But what we're generally seeing is that money is leaving the banking system and going into things like money market funds, okay? That's the general trend right now. So you could see this is the Federal Reserve's balance sheet at the same time. In order to have a system, a financial system that is steady and stable with low volatility, not the VIX index, but actual true volatility that's low, you need to have stimulus, okay? Because we've gone into basically a post-mortem type of financial system. It's a zombie banking system, okay? So you can see that zombie walking around, okay? And it's lurking around your corner. But the problem here is that that zombie's dead, okay? And it's able to do this in such a way because of what? The stimulus that it has. Different scenario with the zombie movies, but in this case, with the financial system, you got to think of this like on that aspect of the fiscal and the monetary. So what do I mean here? The fiscal being the government, how much money, the stimulus packages and all these different things. And on the other side, the monetary side, that's the Federal Reserve and other central banks that have been pumping out money. And they've been doing that a lot over the last several years. And through different programs, the Federal Reserve is doing that today. And so what we can see is the general trend over the last while since they began their quantitative tightening has been that the balance sheet had declined quite a bit. And then what happened with the bank turmoil and everything, the banks started utilizing the Federal Reserve. They started saying, okay, you're the lifeline. We're going to go out to you. We're going to take from this as a temporary measure. Now they're doing that a lot. But we could see on the chart right here that the trend has started to go down. So they are weaning off of their mortgage-backed securities, toxic assets, and they're weaning off of their treasuries as well. At the same time, other banks are going out there and they're saying, we need to use your emergency programs. So this is one that I wanted to show you here. Bank Term Funding Program. That's the one that they set up. And the banks, despite the fact that it's not a very attractive, like the rates and things are not very attractive, they're utilizing this because they're worried, they're concerned, and they're going here in this direction. So that's something important to note as well. And it's at or still at a record high. It's not as if it's declining and sort of dispersing. No, they're using it more now. And you could see specifically Bank Term Funding Program, the middle, the red, is at a record high. So these banks need to use this thing. They don't want to, but they feel the need to use it right now. Isn't that of concern to you? Like, it's not as if it's dissipating and going away. They're using it more than ever before. Federal Reserve warns of credit crunch risk after U.S. bank turmoil. Lenders signal plans to tighten loan standards as depositors withdraw cash. That brings us together in here in this moment, okay? So I've been talking about this for a while. If you've been on the channel, you know I've been talking about the credit tightening. Quantitative tightening, the number one factor. Quantitative tightening essentially means after having printed all this money to buy up mortgage-backed securities and the treasuries, they have started to wean off of that. They can do this in two ways. As these things mature, so let's say it was a 1 year debt instrument, they would buy that, and then after that 1 year, instead of buying it back again, they just let it go off, okay? Go off the balance sheet and they could wean off. Or they can actively sell, but that means there needs to be a buyer. And if there isn't a buyer, because the Federal Reserve has trained the market that the Federal Reserve is the only buyer, and when they're not there, nobody else is buying, well, then you got a problem, okay? So right now what they're saying is you've got a credit crunch because we're not doing this. At the same time, the banks are concerned, the corporations are starting to hold back, and even individuals are starting to look at the whole scenario and think, I think we got a problem here. At the same time though, consumers are still spending more than ever. Inflation is still very high. We have all of these happening at the same time. I know it's a lot, it's confusing, but that's why you're here, to get the truth. Make sure you hit that thumbs up button and subscribe to the channel. I'm going to bring you all the details and you don't have to guess. You just got to tune in. That's all. The Federal Reserve has warned that the recent banking turmoil could fuel a broad credit crunch that risks slowing the U.S. economy, while lenders told the central bank that they plan to tighten lending standards due to the worries about the loan losses and deposit flight. This is coming directly from the big banks, directly from the Federal Reserve. You don't have to listen to me, okay? The U.S. Central Bank said in its twice-yearly financial stability report that despite decisive actions by regulators and officials to tackle the recent regional banking crisis, worries about the economic outlook, credit quality, and funding liquidity could lead banks and other financial institutions to further contract the supply of credit to the economy. So when there is concern, you're going to see this. It is very clear, and we can definitely put that on the front page. Okay, it's not going to end up on the front page of all those websites and those newspapers out there, but certainly on your mind, you should be thinking about this and the ramifications. What does it mean? Well, of course, anytime there's a contraction, that means a slowdown, economic slowdown. And we are now seeing that showing up in many different sectors. Okay, and that really isn't very good for a lot of businesses. The one that you should be focused on, number one, is commercial real estate, both on the office side as well as in the retail side. Okay, both of these very bad. The residential in a lot of areas actually is performing very well. Some of them are at record highs because of limited inventories in some cases, fear of missing out in other cases, investor speculation. It's the same with the stock market. A lot of speculation is taking place, and we know that. It's not as if anybody's denying it. Fed report highlights the risk of bank exposure to commercial real estate, and that's really the big one. And I just wanted to highlight that, make sure I put this up here to highlight it. Smallest U.S. lenders tend to be most exposed to commercial real estate with less risk for bigger banks. Okay, so I think it's 50 to 60% from what I had highlighted before on the small, you think, oh, the small lenders, oh, they're lending to, your grandma. No, that's not the case. They're actually really exposed to commercial real estate. So that's part of it, because we know that's not in a good position today, right here and now. So even Jamie Dimon, the CEO of JP Morgan, is basically saying this, essentially the same thing about what's happening with the banks. The bank's so-called war room will probably start daily meetings on May 21st and ramp up to 3 times a day if the standoff over the debt limit drags on. We've got to be very careful about getting close to default, which could cause a financial panic. It's unfortunate. It's time-consuming. Hopefully it won't happen, but it affects contracts, collateral, clearinghouses, and clients as well. Of course, they talk about the banking crisis, regional banks, looking at all of this. Jamie Dimon is talking about this. You take it with a grain of salt, of course, because you don't know what's really there to move the market or do this or whatever. But I do think that it is a concern. You've got the debt crisis. Not that I don't think, I've said it 1,000 times, they're going to increase the debt. But what comes out of it, that's really the problem. You have a crisis, oh, you pose that solution. You know what I'm talking about, right? Okay. FDIC wants banks bigger than $5 billion to pay for SVB and signature failures. I'm not so sure what's going to happen with all of this. I want to see how it unfolds. That's all. So I'm just bringing that to you. Federal Reserve's Fed Now, you remember the Fed Now, I covered it here on this channel. If you weren't aware of it, essentially it's like a payment system that could speed up and hopefully make things a lot cheaper to transact. Companies are now signing up to that. And in this case here, they're talking about integrating with Metal blockchain. The integration will allow users to instantly convert cash to stablecoins for use in DeFi protocols. So this is one of the first that has done this. And more companies, more institutions, more frameworks or what have you are going to be signing up to the FedNow service, and ultimately bringing us closer and closer to a digital, cashless society. And that's where it is all going towards. And I understand for many businesses, do they want to be dealing in cash? And a lot of businesses today don't have anything to do with cash. Nothing. They don't utilize it. They don't take it in. They don't pay it out. It's just not cash, all digital. So any change would really just be on the back end. There wouldn't be any real change. So we'll see all the mutual fund companies. We'll see all the big fund companies, pension funds, like all these different things that are moving cash around 100% digitally anyway, are going to switch over to this system. Why? Because it makes things easier, supposedly it's safer, and so on. But that gives more and more control over to institutions that we don't have any oversight. We have no transparency into what they do. And so, of course, we're going to see problems with that. It's going to be a problem. What if that FedNow system goes down and you're saying, hi, can I go and buy this food for my family? Oh no, the FedNow system's not working today. So that's really the issue that is of concern here. And that's why we always need to have a backup plan. It is critical. It is crucial, more now than ever before. That's why I talk about the pillars of prosperity. Only a couple thousand people have watched this video, and yet it's probably the most important one. Pillars of prosperity, 2 things. We're talking about increasing your income, and we're talking about having preparedness and self-sufficiency. If you actually want to be prepared and informed, you can watch this video. I'll pop it up on the screen. Pillars of prosperity. I'll see you there. Take care.